Let's go straight to FIIG Securities. We're watching U.S. Treasury futures. They've dropped as U.S. election week trading kicked off in the wake of that FBI news in regards to Hillary Clinton. Let's flesh that out a little with Simon and Michell from FIIG Securities. So, Simon, welcome to the program. Good to see you. Yeah, I guess this is the kickoff of U.S. election week. So tell us what U.S. yields are indicating.
Good afternoon, Nadine. And yes, look, interesting because if you have a look at US yields, they're actually down a few points. So that would suggest a little bit of safe haven, a little bit of money moving to the sidelines and just waiting to see how this election plays out. It'll be really interesting to see their time on Monday, whether we do get a little bit more positive sentiment, as you've seen reflected here domestically. But at this stage, bond yields moving lower.
Okay, what about Aussie yields? Sorry, just clarify that point for us.
Absolutely. So the opposite direction here in Australia, and just like you're seeing quite a lot of risk on in the equity markets, we're seeing that in bonds as well. So the reverse action, we've actually seen yields move a little higher here in Australia, so up around 2 to 3 basis points. So the opposite direction what we're seeing in the US at the moment.
Okay, while we have you here, Simon, I'd like to get your thoughts about this report coming on my Bloomberg terminal today, quoting BlackRock, saying that Australia could lose its AAA credit rating by the end of the year. It's talking about debt levels rising and also the fact that the Australian government is likely to fail to get some of these real budgetary savings measures through. How seriously should we be taking this red flag coming from BlackRock?
Look, it's certainly a concern. I think that, you know, the rating issue is one point, and we've certainly seen the government and the opposition raise that in recent times, the risk of losing that AAA credit rating. But I think the, you know, what's driving that is more interesting, and that's really this inability for the government to solve some of these fiscal policy issues. That's led to a continuing increase in the level of government debt. That means that the government's issuing more bonds, and we saw that reflected in the first ever 30-year Commonwealth government bond issue only a couple of weeks ago. About 7.6 billion. So, you know, pushing the length of its borrowing out longer as well. Now, we're about to reach 500 billion around June next year in Commonwealth government bond issuance on the back of that debt. And as that volume's increased, we've actually seen the level held by offshore investors drop. So if you go back to 2012, about 78% of our bonds were held by offshore investors. It's now down to 59%. So you're not seeing that demand grow as the volume of issuance grows. Now, what that could lead to, if you don't have offshore investors stepping up to buy those bonds, the rates or the interest rates at which the government's going to have to issue those bonds will move higher. So, you know, it is a significant thing. It does increase Australia's borrowing costs, and it is a real concern. And we've seen this from central bankers around the globe saying, you know, rates are so low, their ability to continue to use monetary policy and lower rates further is getting quite low, and therefore they're calling on governments to focus more on the budget, on the fiscal side.
Simon, Tony Davison from Henderson Maxwell here. I'm intrigued by that percentage drop in terms of ownership by foreign owners of Australian bonds. What is driving that, given that we're a relatively high-yield country and presumably a fairly attractive low-risk destination for money? What's sort of driven that reduction in the past couple of years?
Well, absolutely. We also have very attractive rates at the moment too on a comparison basis. So, look, I think that, you know, as that level of issuance has increased, you know, they take that into account, and their share of exposure perhaps to the Australian government, you know, that's going to be fairly static, and so they just reach those limits, and they're just not able to continue to step up and take advantage of that. Look, I would also suggest, Tony, that as we reach the likelihood of the US Fed increasing rates next month, subject to the next 48 hours, you know, I think, you know, they're probably waiting on the sidelines for higher levels coming through the US curve. They'll certainly be higher in comparison to Aussie. So there could be a little bit of repositioning around an expected change in rate levels in the US as well.
Simon, thank you. We'll have to leave it there. Appreciate your time as always.
Thank you, Nadine.
Checking in with you tomorrow. Simon Michell there from FIIG Securities. Final thought, gentlemen, before we go to break. It has to be quick. Are you sitting on your hands for the next 48 hours, Tony? Are you looking for those buying opportunities?
We're buying very, very little at the moment, but one or two things here and there. Most of the buying will be done at the back end of the week or back end of the month once we've got a view on what the outcome of the election is.
So, Michael, sit tight, ride out this volatility in the next couple of days?
We're much the same, sort of 10 to 30% in cash for most of our clients. So we'll be waiting to pick up opportunities once we get that clarity.
All right, guys, thank you so much. Appreciate your time as always. Michael Wang, FIIG Securities, Tony Davison from Henderson Maxwell. That's it for me.